Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name is John Addis. I'm the founder of Intelligent Investor, and I have with me here this morning, on late notice, centre-back Nick, who is stepping in for Gaurav, whose kid is otherwise... What is he? I think he's got a bad leg from playing sport, and he doesn't normally play sport. So thanks, Nick, for stepping in. And we've also got Canadian Graham here to talk about our major topic this morning, which is CEO tenure. Graham, we've had a big announcement, I think it was last week, from Sonic Healthcare, the CEO there, who's been there 32 years, which is, even by my standards, a stunning amount of time. He's off. His replacement is stepping into some very large shoes, and it raises the issue of how important long CEO tenures are, because we have this contrasting example of Don Mage, who's been at Domino's Pizza for a long, long time, and I think that stock has fallen 90% from its highs during the pandemic. So, Graham, let's kick off. Is CEO tenure a really important thing that investors should pay attention to?
I think it is. I think that who's running the ship definitely matters. And in general, I would say long tenures are better than short ones, depending on who the CEO is. But I'm much more concerned by the increasing trend for them to just stay a couple of years. A lot of CEOs seem to be joining, and then they'll try and fix something up. Then they'll move on as the soonest sign of their options vesting, and then, that's it. They're gone. They leave usually some sort of short-term disaster in their wake as they've tried to grow earnings too quickly at the expense of the long term. So in general, I like CEOs that stick around, that then face the consequences of their decisions early on. What about you, Nick? How do you feel about CEO tenure?
Yeah, I tend to agree. My only pushback is you can have a situation where CEOs stay too long and the group becomes sort of complacent and the culture really forms around that one individual. Two examples over the last year on the ASX are Chris Ellison at MinRes and Richard White at WiseTech. And,
right.
I know they're founders as well, but the whole culture and governance of the company was really, sort of quite poor and centered around these two figures. So it's a fine balance, but overall, I'd rather a CEO that's, been in the chair for a few years and really led the business, rather than a company that just stops and starts and changes CEOs all the time. That's usually a red flag. One thing I look at if I'm looking at a company fresh is how many CEOs have they had over the last 5 years, and generally, if they've had more than say two, it's a pretty bad sign.
Yeah, Graham, do you agree with that? Like rapid CEO
totally.
turnover is bad. It's a little bit like Manchester United. Like you've got, I don't know how many managers they've had since Alex Ferguson, but it's got to be 7 or 8. And you go, well, they're not all bad managers. There's something wrong with the culture of the club that allows or permits that many managers to come in. And I think you could make the same argument about companies that rapidly turn over CEOs. There's something about the business, maybe the major shareholders, the board. There's something going on there that the CEO can't fix, and when they realize it, they're off.
Yeah. There's also a hidden cost to all the changes, because each different strategy as it's being implemented inevitably has some sort of one-off costs involved at the beginning. And if you're changing that every couple of years, then those one-off costs are pretty consistent.
Right, yeah, the clearing of the decks, that all CEOs tend to go through, especially in the bigger businesses. If you're doing that every couple of years, that's a lot of write-offs over a 5-year period. So tell us about Sonic, Graham. Why for the obvious reasons, Colin Goldschmidt is going because he's been there 32 years, but he's taken this company from a solitary outlet, a pathology outlet, into what? The biggest pathology company in Australia.
And in several countries actually. So he's grown under his watch. Revenue grew more than 300 times, which is pretty impressive. And he did it through what at the time was a fairly unique strategy of consolidating these smaller pathology groups and then trying to automate more of the setup behind the scenes. So he kind of took that decision here in Australia and shipped it overseas to Germany, the US, Australia, and it's done quite well. So the company is now fairly even split between several different countries. And so overall, I think he did a great job. It is going to be a hard act to follow. But one thing that I did like about the announcement was that they immediately announced a successor who was internally hired, Dr. Jim Newcomb. He runs the original Sonic Lab, actually, in Sydney. But what I liked about that is, first of all, it's an internal hire. So the board knows who they're getting. It's not some external CEO. The transition tends to be smoother because Newcomb already knows the business, presumably quite well. And on top of that, I think it just allows an increase in the ranks within the company. So there's always an incentive to the lower ranking executives to develop, to stick around, to really kind of get to know the business better. Whereas these ones with the constant CEO turnover and all these external hires, I think that mindset filters down through the company, and it just doesn't incentivize people to stay and actually improve or to focus on the long term of the company itself, which they might one day be running if they play their cards right.
Right. I think this is an important point, that you need to differentiate between a founder CEO and somebody who's just coming in for, to warm the chair for 2.5, 3 years and, get their options in the money and then whiz off. A founder CEO is a different kind of thing to just a CEO who's been brought in by the board after a global search.
Yeah. Though what's interesting, I mean, in this case here, Goldschmidt wasn't the founder of Sonic. So it's also an example of where you can get a kind of hired CEO that does a really good job. He never owned a huge slice of Sonic. He had at the end, I think, an ownership of maybe 14 million or so, which is nothing compared to Sonic's market cap. And he gets paid a few million a year. So relative to his earnings, it's really not a large stake. And you kind of saw a similar thing with Brian McNamee of CSL. He stayed there for at least a couple of decades, hardly owning any of it, but still grew the business 1,000-fold or something or other under his watch. So although I definitely prefer founder-led businesses, I know you do too, but these are good examples that you can get career CEOs who can still make a massive difference to shareholders and without the usual signs of, engagement or ownership.
Yeah. What about you, Nick? How do you feel about founder CEOs versus managerial CEOs?
Yeah, I guess it's pretty interesting. That I mean, the name that immediately comes to mind when you talk about a managerial CEO is Jamie Dimon at JP Morgan. Everyone would associate him with sort of just the head of banking almost in the US. He was there through the GFC and has led the business now for, I think, almost 20 years. But you forget that he wasn't the founder of this business. This business has been around for 120 odd years, I think. But I think if he left today, the share price would be down 15% on a $700 billion market cap. And so there is this line where managerial CEOs almost become the sort of founder-owner CEO, if you know what I mean, without the equity stake, even though he has a large equity stake. But they're actually ones to follow, I think. And usually they come through internal appointments. They're not usually bouncing around, in this case, several banks and then found JP Morgan. Usually they rise up through the ranks. It's a really interesting one because there's plenty of examples of those managerial CEOs that have sort of, gone on and sort of taken over the business culture and produced fantastic shareholder returns. Another one that sticks to mind is Greg Case, which is, most people won't have heard of him, but he is the CEO of Aon, and Aon's one of the largest insurance brokers in the world. They've had two CEOs, the founding CEO, Pat Ryan, and Greg Case came in 2005 and has now been there for 20 years. But most people now would associate Aon with Greg Case rather than Pat Ryan. So it's interesting. I love finding companies with managerial CEOs rather than the I think of career CEOs as, people that just jump between companies every 3 or 4 years to chase option packages. I don't really like that kind of management team.
Okay, so career CEOs that tend to jump around a lot is a no.
Mm-hmm.
Long tenure CEOs who are making the company that they're managing their life's work get to tick.
Yeah.
Massive tick.
What about founder CEOs? Because we've seen all sorts of problems, most recently at WiseTech and also Mineral Resources with Chris Ellison, who are so wedded to their business and have done such an amazing job that they fail to see when they're erring, and they can engage in behaviors that maybe managerial CEOs wouldn't, because they don't feel the freedom and the latitude that founder CEOs get.
Yeah, I mean, again, it's hard, isn't it? Because I think if you listen to Buffett or various other well-known investors, they'd be like, we love founder CEOs that and for the most part, the stocks of founder CEOs outperform the market. I mean, there's a fair bit of research around that, but you do get this. There's always I remember what my university professor once told me, and it's this saying that in finance it depends, and it really does. Like, there is no hard and fast rule, and you've just brought up 2 examples where it has actually worked out well for shareholders, but more recently it hasn't. And there are other examples where the founder CEO, the board can't stand up to them. There's governance concerns, and they sort of just get kicked down the road. Maybe a few board directors resign, and that happened at WiseTech, not just recently, but a couple of years ago, when it was sort of the same. Well, oh no, that's okay because this is a founder CEO. But unfortunately, some of these founder CEOs still think the business is completely theirs, as in they own 100% of it, and don't really respect minority shareholders, and can't see the faults of their own actions and what they're doing. But again, it depends. I mean, I'd probably pick a founder CEO over a career CEO, most of the time. But it's you've got to go through and do the work on these companies, because it's not just a tick the box at all.
I think this is an important point. There's a tendency, like I think they kind of call it hero bias, where you think that a business is successful because of a couple of people, or maybe even one, who are actually running it, when there are far bigger forces at play. And you could bring a really, really good CEO into a terrible business, and the terrible business is going to make them look poor. Graham, what are your thoughts on how you look at a CEO and what influence they have over a business, and what kind of CEOs do you tend to prefer?
Well, I think in general, I do prefer founder CEOs, or those that have been there for a long time, as in Sonic's case. I think the issue that does show up with those kind of companies, though, those kind of CEOs, is that people give them maybe a bit too much patience and a bit too much leeway, because they've built something that has done really well over an extended period. I think you're more likely to stick with them for a while through things getting bad, and maybe as an investor not even noticing that things are getting bad, or at least if they are, you think, oh, well, they've grown the business so well before, they can turn it around now, when it might be that the company is just in a different situation, or is experiencing some sort of different threat that a different CEO might be better for it at this stage. Often with founder CEOs, they've done a really good job of growing a small business to today, but you're kind of facing a different set of opportunities and risks if you're a large business trying to just hold your ground or continue to expand from that. So there's probably a time where all CEOs do expire from their usefulness to the company. And there's probably a sweet spot of, 10 or 15 years where they've both got the experience, they've got the buy-in from all of the shareholders and from the staff and all of that to see their vision, whatever it is. And then after that, they can, I guess, their value starts to decline.
Right. And in those circumstances, you need a board that is going to be able to recognize that and stand up to somebody who's probably imprinted themselves on an organization in a very substantial way. And that's really, really hard to do. We saw the failures of corporate governance in Mineral Resources, there was nobody really to stand up to Chris Ellison. I think you see it with Mark Zuckerberg as well. You know, the golden shares that a lot of the big Silicon Valley founders own give them license to just do what they want. And they're not, in the end, they tend not to hear contrary opinions. You know,
that's the risk. That's the risk with these long-term CEOs, whether they're founders or not, is that people will, like, the more power they have or the more time in that position they've had, they end up not having the truth spoken to them because they are just seen as being inevitably in that powerful position. So it takes a pretty good CEO to be able to encourage the opposite to that, which is constant feedback and people willing to say, hey, this strategy isn't working that you've got us going down the road on. And so I think there are CEOs out there that do that, but at some point that power does kind of ruin the company in some ways.
It does, and this is one of the many things that makes investing hard. So we're going to end our first segment there. We're going to come back in a couple of minutes with Nick, who is going to explain why data providers are better businesses than stock exchanges, which kind of explains why we haven't had a buy recommendation on ASX for a very, very long time. We'll be back in a moment.
Want to enjoy retirement on your terms? Whether it's travel, hobbies, or more time with loved ones, the key is planning ahead. With longer lifespans and rising costs, relying only on the age pension and employer contributions may not be enough. That's why InvestSmart has created a free retirement ebook. It includes practical strategies to make the most of your super, what you should know about self-managed super funds, and why it can make sense to invest outside of super. It's never too early or too late to start shaping the retirement you want. Download your free copy today at investsmart.com.au/guides.
And we're back. Nick, tell us about the transformation from exchange to data provider from the London Stock Exchange Group. And tell me also why, if that transformation is true, why are they still called London Stock Exchange Group?
Well, to answer your second question first, I have no idea. They should change the name. It's kind of ridiculous, isn't it? But yeah, no, this company was set up in 98. It goes back to Jonathan's Coffee House, where a guy called John Casteran started writing or publishing, stock and commodity prices on the walls of these coffee houses, and that was really the birth of the London Stock Exchange. But fast forward a couple of 100 years, and stock exchanges aren't really as good a business as they used to be.
But these are monopoly businesses, Nick. Why would they not be great businesses? Why?
There's a few reasons. Yes, they are monopoly businesses, but they are monopoly businesses for listings, if that makes sense. Mm-hmm. What they are not monopoly businesses for are trading, and trading's where a lot of revenue comes from. So, like, for example, the ASX, let's take BHP. BHP's listed on the ASX, but you can trade its stocks through the ASX or through Chi-X. This same goes for the New York Stock Exchange. You can trade companies listed on the New York Stock Exchange through other venues. And the same goes for the London Stock Exchange. So they don't have a monopoly over trading and earning the trading fees on their stocks. And then on the listing sides where they do have a monopoly, there's been lots of competition, as in, a global business like Atlassian, it might be based, I think, in, where is it? Is it Ultimo or Surrey Hills, somewhere around there in Sydney? But it's listed on the NASDAQ. Right. So companies that are global now can list all over the place. And the other thing here is private equity and venture capital are keeping companies private a lot longer. And in some cases, they have no intentions of taking them public. Or they're buying public companies and taking them private. And so this is actually reducing listings. So I think at the London Stock Exchange, I want to say listings is about halved. And that's certainly the case in America, where I'm pretty sure listings have halved over the last, say, 2 or 3 decades. So on one hand, you don't have a monopoly over trading fees. And then on the other side, you have listings, and there's been just less listings over time and less IPOs. And that's the other bit here is these stock exchanges really do rely on corporate action, so capital being raised or new listings. And when that falls down, so do their fees. And you can sort of see that at the ASX, where it's sort of muddled along. It's not a bad business by any means, but it really hasn't grown its profits a whole lot in the last decade. And the London Stock Exchange isn't much different either. The New York Stock Exchange isn't what it used to be either. So that brings us to why on earth are we interested in the London Stock Exchange? And the reason is the actual exchange business only accounts for 4% of its revenues now. So, who knows why they haven't changed the name, but they haven't as of yet.
You should suggest it to them, Nick. It's obviously not occurred to them, otherwise they did it. I think you could be on for a big bonus if you did that. Plus, it would probably push up the share price.
Yeah, they might make me the head of strategy. I'm not sure. No, yeah. So the London Stock Exchange has been making this move to more data recurring businesses over the last sort of 2 decades. And this really capped off with their acquisition of Refinitiv in 2021 for, I think, around $27 billion. So it was quite a big deal. And that means now that the London Stock Exchange group, I should say, there is a group at the end. I think they did add that bit. So recurring revenue now accounts for about 70% of the total group revenue, with the last 30% being more volume exchange businesses. 4% of that is the actual London Equity Stock Exchange, and then there's a post-trade business, which is essentially the London Clearing House, and also they own a 50% stake in TradeWeb, which is essentially benefiting from the electronification of bond trading, mainly in America, but also around the world. Bonds were or have been really traded over the phone, and now they're moving more online, which is kind of crazy to think about. In the world of AI, that a lot of bond trading is still done over the phone, but it is the case. It's kind of crazy.
Why on earth is that? I mean, just out of it, like taking a complete sort of U-turn here, but why is it done over the phone?
I'm not sure. It might be just a bit of inertia. A lot of the systems are built in that way. These markets are quite illiquid some of the time. So, you have to there's a bit of price discovery potentially. But I don't have a really good reason. I do know it's changing. It's changing quite quickly. And, TradeWeb's volumes are really benefiting from that. They're not the only player, though. There's a few people that are benefiting. I might shift us back to refocusing on the...
sorry about that.
Yeah, no, you're right. It's a good question on the reoccurring businesses. So really now the London Stock Exchange Group is driven by 3 main reoccurring businesses, and there's a data analytics group, and this is broken into 2 segments. One is a kind of a weaker business, which is... a company called Workspace, which used to be the old Econ, and this is really a financial terminal provider, so very similar to Bloomberg, and they've been losing share there for a number of years, but that was really because the last owners of Refinitiv didn't really take care of this asset at all, and London Stock Exchange has come in, put a lot of money into it, revamped the product, and finally transferred all the users onto the new product. And I think now there's a chance that they can maybe pass some price through, maybe keep lower their churn a little bit in that business, and start to grow it a little bit faster than they have done. The other part of this business is a data feeds business, and this is where they gather about 100 million odd prices for stocks, bonds, commodities, you name it, from all around the world, and they've got data of, they call it the tick history of these instruments going back about 30 years, and so this is really really important for quant traders, hedge funds, that they can know the exact prices of all these stocks, and back test all that data. And what the beauty of this business is that the London Stock Exchange, or the data analytics division, really just combines all that, all those instruments from all exchanges all around the world into one place, and you can buy it off one person rather than trying to negotiate with hundreds of different exchanges all around the world. So that's a pretty good business. It's growing mid-single digits, churn's very low, and there's high switching costs. And then the two sort of crown jewels, even though they only combined for about 25% of revenue in total, is the FTSE Russell index business, which is very similar to S&P Global's index business or MSCI's index business. And this is a really good business. Fund managers, they need an index to compare to when they release their reports, to their investors. They need an index, to compare to for regulation purposes. And there's really, once you've set your index, it's very hard to change it. There's huge switching costs, and this gives the index providers enormous pricing power, and it's pretty much an oligopoly between those three players. And then the last business is quite good as well. It's risk intelligence. Risk intelligence is essentially a know your customer product. I think it's called WorldCheck. And what it does, it has a database of 5 million individuals of, oligarchs, war criminals, other types of criminals, and sells
a birthday party list.
Birthday party list, depending whose birthday it is. Yeah. And then they sell that data back to banks, and it's really for banks to make sure they're not committing fraud or doing business with any individuals that are on watch lists, et cetera, et cetera. And that's a very, very good business with lots of pricing power. It's pretty much it's inexpensive, and I love these types of businesses where you really can't cut it. It's not like we can go, we're not going to, do any financial checks, even though some banks in, various parts of history have done that. But you just can't really cut this cost. So it's a fantastic business. I think wrapping that all up, I think the opportunity here is stock price is down a fair bit because the integration with Refinitiv has taken longer. And it now looks to be coming to an end. And you're buying this business that has, 70% recurring revenue growing at sort of mid to high single digits at under 20 times earnings. And we think there's a real chance that they can expand their margins as well as the integration winds down. I wouldn't quite classify it as a turnaround. I think the business quality underneath is very good, and there's been, fairly good momentum there as well. But it looks like a real opportunity. And, as I started with, that stock exchanges have been quite poor investments for a while, and, for all the reasons I mentioned, yet this trades at a multiple below the ASX. And it's a far better business, and I don't think that's been recognised by the market yet.
And a multiple that's a lot less than what S&P Global trades at, or MSCI, which is around 29, and I think you said that LSEG is trading around 21. So
even less now, probably under 20.
Down a bit, yeah. Okay. What about the risks? Is there a currency risk here, Nick?
Yeah, I mean, it's listed in the UK, and there's a bit of risk around that. You've saw a couple of years ago with I think it was Liz Truss, and the bond implosion, the pound fell quite quickly. That could certainly happen. So there is currency risk. I would say that most of the revenues now are in US dollars rather than pounds. So it's more translation risk rather than actually earning their money in pounds. And that's another thing that they could, if I did put my head of strategy hat on, they could even take the listing from London and put it on the New York Stock Exchange or the NASDAQ, because most of the business now is from America and other parts of Europe rather than just England or Britain. So currency is a risk. I think the biggest risk here is just that we're wrong about Refinitiv, and the integration isn't close to finishing, and there's more problems, and they keep kicking the can down the road. But I think there's enough quality in the other businesses to offset that, even if that's the case. But I think that's the risk. And then the other risk is, of course, that 30% that is driven by exchange, traded sort of volumes. And if you had a situation where volumes fell, that would impact profits as well.
Nice. That's an interesting story, Nick. Thank you for laying it out for us. It's on our buy list right now, and we like the look of it, but obviously you've got to do your own research. Now, to our final segment, we have some cultural recommendations. Graham, let's start with you.
Well, I've been watching a new show called King and Conqueror, which I'm not sure if any listeners have picked up, but it's on the BBC at the moment. It's just come out. It's about the lead up to the Battle of Hastings and the conquering of the UK. And it's an interesting show if you want something historical drama-y to sit back and watch at night. It's definitely well acted, I think. The only catch is that it's completely historically inaccurate. I'm a bit of a history buff, so I know a fair bit about the period already. And they're making up characters, making up storylines. They're completely off with the dates in terms of the age of the actors and the age of the actual people who they're supposed to be playing. And they've pretty much just taken what was already a good story and tried to jazz it up for entertainment purposes. So that's a bit disappointing, but
was
it's
it
still
done
good.
by Oliver Stone?
I'm not sure.
Okay. All right. I do have a question about Battle. Because there is a town. My mother used to live quite close to Battle. It's in Sussex, and I didn't know whether the word battle, as in conflict, came after the fact that this epochal battle occurred in this town called Battle, or so the word is named after the town, or the other way around. Can you solve that for us live on this podcast, Graham?
I am Googling as we speak because now you've got me interested. I always assumed that it must have been named after the event that took place there. But
it's weird. It's called the Battle of Hastings, and it wasn't actually in Hastings.
So, well, it was pretty close. It was at Battle.
It was at Battle. Anyway, okay, Nick, what about you?
Yeah, no, I didn't know if I had one, but I have thought of one. I'm reading a book at the moment, and it's called Black Girl in Pyongyang, and it's about it's a story.
Amazing.
Yeah, it's written in the story of written by and the story of Monica Maracas, and Monica was one of the youngest daughter of the equatorial dictator Francis Maracas, who died in the late 70s. And I guess part of colonization was, one of the worst bits, but there was lots of bad bits. But one of them was that when the colonial powers left Africa, there was pretty much no educational institutions in a lot of these countries, and a lot of these countries weren't too fond of the West. So the dictators and powerful rulers in these countries end up sending a lot of their kids to North Korea, Russia, Cuba, and China to do primary school, high school, and then university. And so Monica was sent, I think, at the age of 5 or maybe even younger, to Pyongyang. And the story really, the book covers her life there. When she's 8, I think her father's shot dead by her cousin, his nephew, in Equatorial Guinea. It's just fascinating. I'm only about halfway through, and I don't want to wreck it, but it's a really interesting book. It's not that well written, but I'll cut her a lot of slack. It was originally written in Korean, and then change over to English and various other languages. But it's amazing, and it gives you a really different view of Pyongyang and North Korea than probably what you see on the news, which is kind of interesting.
Fantastic. Good to get a book on there as well, Nick. I've heard very good things about that. Okay, I'm going to read out some film titles. You're going to tell me the actor that's common to them. Let's start off with Legal Eagles, Charlotte's Web, Brubaker. Any clues yet? Pete's Dragon, The Electric Horseman, Sneakers.
I haven't watched any of these.
Endgame. Here's a big one. The Great Gatsby, Captain America. Come on. Ordinary People. A Bridge Too Far, which is a biography of Kevin Rudd. The Chase, quiz show. All the President's Men. The Old Man and the Gun. A River Runs Through It. Come on. Everybody's screaming out. Butch Cassidy
the world's
and the
most
Sundance
popular,
Kid.
What's it called? Dancer in the background.
He's just died. Robert Redford. Robert Redford has been in some incredible films. Like Butch Cassidy.
Was he a main character in those? I feel like some of them.
Not all of them. I mean, I don't think he was a main character in.
Just an extra in the back
of Avengers Endgame, but he was in it. He wasn't. It probably wasn't in Captain America as a major feature of it, but still. But Butch Cassidy and the Sundance Kid, Sting, Out of Africa, 3 Days of the Condor, Ordinary People, just incredible films, and a brilliant, brilliant actor. So I'm going to recommend a film that has almost no dialogue. It's just him talking to himself. Came out in 2013. It's called All Is Lost. It's got a great depressing sort of title that appeals to me. It's about a sailor who goes off on a round the world trip in a yacht and then gets taken out by a cargo ship. And it's about his struggle to survive in ridiculous circumstances. There's hardly any dialogue. It's all just him acting, and it's incredible. It's absolutely incredible. So there's something to watch over the weekend. Okay, we're off. Nick, thank you for stepping up and coming on, filling the Gorav-shaped hole. And Graham, thank you too. We'll be back with you in 2 weeks.